Global electrical vehicle sales remained solid in the first half of the year. EV penetration in China, Europe, and the US has been accelerating on the back of surging oil prices and energy crisis. This is a positive development despite growing concerns of global economic slowdown, customer affordability after EV prices hike, and China lockdown interruption to the auto production. Despite the strong end demand for electric vehicles, supply constraints remain throughout the first half of the year. The auto industry's supply chain normalization process was slow with ongoing chip shortages. China's auto factory production halt during lockdowns added to EV supply chain tightness. The minimum customer waiting time of top-selling electric vehicle models in China maintained a stable range of nearly 7 weeks by the middle of June. The similarly long waiting time applies to other countries. Higher global EV penetration year-to-date is forcing companies, including car makers and component suppliers, to accelerate their EV transition. With current high energy prices, the total cost of ownership in the US is lower for hybrid EVs and battery EVs compared to gasoline-powered vehicles, especially with tax incentives. The launch of new EVs by automakers around the world and front-loaded demand in anticipation of further price hike have also supported this structural transition. Commodity price inflation was another key focus during the first half of the year, leading to price increase of electric vehicle battery-related materials. While prices of battery metals appear to have peaked, lithium prices stay at a relatively high level. As battery costs account for around 30% of the total cost of an electric vehicle, high metal prices have imposed great margin pressure on both electric vehicle companies and battery manufacturers. Some Chinese battery makers managed to confront rising commodity costs by renewing and restructuring contracts. Korean battery makers were relatively better protected due to long-term contracts and a better price pass-through mechanism.
In terms of the market outlook, we believe electric vehicle sales in China will remain strong till the end of the year, on the back of national and local stimulus policies. Consumers will likely shift their car purchase decision earlier to this year when favorable policies are still available. Government recently calls for extension of purchase tax waiver in 2023, which we believe will keep EV sales growing. For the US and Europe EV sales, while the current situation is more favorable to EVs compared to gasoline-powered vehicles, the global economic slowdown could damp auto purchase interest. According to a survey conducted by the University of Michigan in May, consumers expressed record low sentiment towards the purchase of a new vehicle, citing high prices and rising interest rates affecting the affordability of the customers. For the battery makers, the situation could be a little bit more challenging in the next 12 to 18 months. Even though cost inflation pressure might ease after Q3, competition will become more fierce since most of the major players have announced aggressive expansion plans for the next 3 years. Some claim their new capacities are backed by orders from major OEMs and their cost efficient thanks to integrated supply chain. However, gross margin declines in first quarter show that they did have difficulties passing cost inflations to the OEMs. Regarding lithium prices, we believe supply from the top 8 lithium producers in the coming 3 years should be sufficient to fulfill growing demand from electric vehicles, energy storage, and small batteries. China's expansion in the lepidolite project will add extra supply that further ease the current market tightness. But it's worth noting that new projects usually sit on the higher end of the global cost curve, given the lower grade nature for lepidolites, and that will support lithium prices to some extent. Thanks for watching.